Hello there, I'm Alex. Welcome to Sinspiration, where I inspire you to develop a growth mindset. Today I'm going to answer the million-dollar question: when to buy and sell stocks. Investing is a critical part of building wealth, and it is not just for the rich. Most people have access to investing, so I'm here to help you make smart personal finance decisions as early as possible. Before I start, I have a disclaimer that the content of this video is from my own personal experiences. It is not professional advice, so use your own judgment. First, you should know that no one, absolutely no one in this world can buy and sell stocks to get the true maximum gain. Such a person would be able to predict the future, and that is currently not possible. Wall Street's top analysts and the world's best supercomputers using reinforcement learning cannot do this either. That is because stocks are unpredictable, subject to macro and microeconomic conditions, geopolitical events, breaking news from companies, and buying-selling decisions from large shareholders or financial institutions. Therefore, we as small retail investors can only do so much to get our fair share of the gains of good companies with limited and delayed news. Let's talk about those different strategies. Stocks can be volatile and unpredictable. Good news can send the stock price to rocket, whereas bad news can cause it to slump. Putting all your eggs in one basket is very risky. What if you can own a bit of a bunch of different stocks? Exchange-traded funds, or ETFs, and mutual funds allow you to do this.
I actually wanted to talk about index funds, but I mentioned ETFs instead because ETFs can be traded at any time during a trading day, like stocks, whereas for index funds, the buying or selling price is based on the price when the market closes for the day, giving you less flexibility. The pricing of mutual funds works the same way for index funds.
An ETF is a weighted average of a select group of stocks. The best example is the S&P 500 ETF, which consists of the 500 largest US companies by market capitalization, or about 80% of the total market cap of all stocks. ETFs also come in different sectors, such as technology, financials, consumer staples, and energy. ETFs should closely track the index or the weighted average, but not exactly. Financial institutions make money from this difference. ETFs also cost a little bit to own with what's called an expense ratio. However, many offer a dividend as well to offset these costs. Mutual funds are similar to ETFs, with the exception that they are actively managed by a fund manager. In other words, you are trusting your money to this person to rebalance your portfolio over time. You may beat the S&P 500 index and the overall stock market, but you are more likely to underperform in the long run. In fact, according to John Bogle, founder of Vanguard and creator of the first index fund, his book, The Little Book of Common Sense Investing, mentions that only 24 out of 355, or 6.76%, of mutual funds have beaten the S&P 500 index over the past 35 years, from 1970 to 2005. That's terrible odds. I do not recommend mutual funds because of my point earlier. No one can predict the highs and lows of stocks with 100% accuracy, even professionals. With active management, your fund is not exactly tracking the S&P 500 or the sector. Additionally, you'll have higher costs with higher expense ratios. For example, a mutual fund based on growth stocks, POGRX, has an expense ratio of 0.65%, whereas an equivalent ETF, VUG, has only an expense ratio of 0.06%, about 1/11th the cost. Costs compound over the years. There are also capital gains tax that you have to pay whenever a fund manager rebalances your portfolio or sells assets at positive gains. Instead, I recommend sticking to ETFs that track the S&P 500 index with low expense ratios, such as VOO. This gives you diversification and low costs so that you can get your fair share of the stock market gains. Reinvest your dividends to get a compound interest effect. Some of you might think ETFs and mutual funds are too simple or boring. You want to invest in a particular stock that you are interested in or believe will succeed in the long run. When you invest in a particular stock, it is important to consider their business model, financials, and leadership team. Know what product or service this company provides. Do people buy these products or use these services? Do they add value to your life and many people's lives? This is how companies generate revenue to grow their businesses. Publicly traded companies are required to provide financial reports every quarter. These include revenue, earnings, and guidance. Revenue is the income in dollars. Earnings is the income minus expenses or profit in earnings per share. And guidance is their forecast for the upcoming quarter or the year ahead. These financial numbers, especially earnings and revenue, are compared with Wall Street's expectations. You'll want to see revenue and earnings beats and good guidance. Increases in year-over-year performance, as well as strong guidance, typically translates to higher stock prices. But be warned, sometimes the stock price can still fall, even if most or all three of these factors are positive. I have no good explanation for this, except for profit taking. Maybe the stock already had a great run. Finally, ask yourself if you trust the leadership team, especially the CEO. Are they moving the company in a direction you think will lead to greater success? Are they reliable and deliver what they claim? Are they competent? Good leaders have a powerful vision and have the ability to lead a team and company to higher levels. The federal interest rate is the rate to borrow money from the government. Lower interest rates means it costs less for businesses and people to borrow money to grow their companies and for people like us to buy homes. Higher interest rates makes it more expensive to borrow money, and that will slow down growth as well as make home buying out of reach for most people. The federal interest rate was slashed to 0% when the COVID-19 pandemic hit the US in early 2020. Remember what happened after the free fall drops in the stock market? Stocks, particularly growth ones, rebounded quickly because it costs less to borrow money and there was a lot of stimulus money that got injected into the economy. Moreover, a lot of people were snatching up homes with near record mortgage rates at and under 3%. You'll want to own and buy stocks during this period, particularly the growth ones. The US enjoyed this easy money for some time until inflation started to increase too quickly, reaching as high as 9.1% in June 2022, which is up from 2% during normal times. The Fed saw this coming ahead of time, so they announced to increase interest rates to lower inflation. Stocks have fallen so much over the past 12 months, with the growth stocks hit the hardest. Most professionals recommend you hold cash or be very cautious with your stock picks. If you do want to own stocks, you'll want to pick ones that have a low price earnings or PE ratio and solid positive cash flow. These companies are more likely to endure in a high interest rate environment. Typically, this includes blue chip and value stocks. I am no expert in technical analysis of stocks, but I would like to explain the 50-day and 200-day moving averages. A moving average is the average closing price over the past N days. Technical traders typically use these moving averages to set up support and resistance levels to make their trading decisions. The 50-day moving average represents the short-term trend. Whenever a stock price goes above the 50-day moving average, it could be a sign of a positive uptrend. You can add more to your position if you'd like. However, when a stock falls below its 50-day moving average, it could be a signal to a longer downtrend, or it could be just a dip in the price before it trends upward again. The 200-day moving average represents the long-term trend. Whenever a stock price crosses the 200-day moving average in a positive trend, This is called a golden cross, which usually signals a longer-term uptrend or a bullish case. It is reasonably safe to buy a stock at this point. On the contrary, when a stock price goes below its 200-day moving average, this is called a death cross, which typically means a longer downtrend will occur or a bearish case. During this time, you may want to consider selling your stock to prevent further losses. However, I have seen cases where shortly after a death cross occurs, a golden cross happens and the stock actually recovers. So allocate your cash accordingly. The VIX is the Volatility Index, which represents how volatile the stock market is. A low VIX, typically under 20, is good because it means that stock prices stay within a small range. And this means your net worth of your investment portfolio will not change drastically. A low VIX typically means slow and steady price appreciation, which usually translates to a healthy economy. A high VIX, from my experience, would be 30 and above. When there's a high level of uncertainty and extremely negative news on the national and global level, markets can react suddenly with sell-offs. When the COVID lockdown started in March 2020, the VIX went as high as 80. You can use the VIX to your advantage to buy and sell stocks. When the VIX is low, it is generally safe to buy and sell stocks. When the VIX is high and a sell-off has occurred, you can consider to buy the stocks at discounted prices. But be warned that it is possible for the price to fall further. A high VIX is also good for day traders, but I'm more of a buy and hold type of investor. Typically, the VIX and the major stock market indices, S&P 500, Dow Jones Industrial Average, and NASDAQ, are inverses of each other. Whenever the VIX starts to go up, the stock market indices go down. However, I have noticed when both the VIX and the market indices go down, shortly after, the market indices start to trend upwards again. This probably means that the selling is slowing down or coming to an end, so this would be a good buying opportunity. Dollar cost averaging is a strategy where you invest a fixed amount of money on a regular schedule, regardless of the share price. The stock market is unpredictable and volatile, so dollar cost averaging is an answer to this challenge. Only by pure luck will you be able to buy at the lowest point and sell at the highest point. If you keep buying regularly, you'll have an average price for your cost basis, and you'll have positions in both the higher prices and lower prices. No one can time the market. Therefore, my best investing advice to you is to dollar cost average on an S&P 500 ETF as early as possible. This gives you diversification, low expenses, and an asset that you own at an average price with an average annualized growth rate of about 11.8% since the S&P 500 index's inception in 1928. Your reinvested dividends will also compound over time, and the value of these dividends will appreciate as well. Remember that time is your best friend when it comes to investing. So start today if you haven't already. Even a little bit of money can go a long way over 30 or 40 years. I would like to end with the single most important piece of investing advice from one of the world's greatest and most successful investors, Warren Buffett. Be fearful when others are greedy, and be greedy when others are fearful. After hearing everything today, you don't have to listen to my advice. You don't have to listen to professionals' advice, but do trust your own judgment and stick to your investing strategy. While you're busy researching and buying stocks, don't forget to smash the like button and comment below with your comments and feedback. For more self-growth, personal finance, career development, and education tips, subscribe to my channel and follow me on TikTok and Instagram. Sinspiration. You've been Sinspired today. See you next time.